Hi there, ladies and gentlemen. It's James Marley here, co-founder at Livewire Markets, and welcome to the opening panel of Livewire's 2024 Income Series. Things have gone from famine to feast for those investors looking to earn a bit extra from their cash, and it's a great thing for investors. It wasn't that long ago that we had to stretch to find income. Now we're swimming in it. The objective of today's panel is to help you find what some of those opportunities might be, but also to think about how can you make it extend, how can you make the most of this time in the sun. Joining me to have a chat about income investing and the opportunities right now, I have Pete Robertson from Challenger Investment Management, Christopher Joye from Coolabah Capital, and I also have Simon Mills from Morgan Stanley. Before we get started, just a quick advice disclaimer. What you hear today is general advice only. It's not taking into consideration your personal circumstances. Seek out a good advisor, such as Simon.
Thank you.
All right, let's get off. First topic, Christopher, I'm going to start with you. Economies have been quite resilient. Do you expect that to keep going?
We think there's been a period where excess cash savings that built up during the pandemic have insulated economies from the impact of rate hikes. In the US, those savings were worth 9% of GDP and they've mostly been exhausted. And over 22 and 23, that injected the equivalent of 2 years of extra economic growth into the US economy. There's been a lot of talk of soft landings. We've heard that narrative popularly around the world. But the truth is there's been no landing at all because we don't have inflation back at 2%. So we're nowhere near landing on the price stability targets that central banks have. And we do expect a hard landing because right now the world is characterised by an inflation crisis driven by demand side services inflation. Around the world, it's running at 5 to 7% annualised. For central banks to hit their targets, it needs to be around 3%, if not lower. And the only way to really crush services inflation is by putting a downward pressure on wage growth. And the only way to do that is by pushing up unemployment. So we think New Zealand's the canary in the coal mine. In New Zealand, they're in recession. They've had 12 months of negative GDP growth. And unemployment has increased from 3.2 to 4.3%. And the RBNZ's shocked markets this week by actually thinking about lifting rates again when markets had thought they'd be cutting just because they've got weak growth. But they have stagflation. They've still got high inflation and strong wage growth. And so they need to asphyxiate the economy more. And they don't expect to cut rates until the back end of 2025. So we think we're looking at hard landings.
Right. Simon, you probably hear concerns from clients, I imagine, feeling some of the cost of living style pressures coming through. But on the flip side, the higher rates have given them opportunities to put that money to work. How do you respond to clients when they ask about the outlook on the economy and how things are looking?
It's interesting because our view at Morgan Stanley is I think the consumer and corporates have been much more resilient to rate rises than we would have expected. 2 years ago, we were sitting here with almost zero rates in both Australia and the US, and we've had 400 odd points of rises in Australia, 500 odd points of rises in America. We've still got 4% or thereabouts unemployment in both jurisdictions. The consumer hasn't been under serious pressure. Retail spending has been reasonably strong, and corporate defaults are nowhere near long-run high averages. So I think the economy's been much more resilient than any of us probably would have expected, and people tend to be optimistic. Having said that, we published our Global Investment Committee Weekly last week, and I know that our GIC is very focused on consumer sentiment, and recently consumer sentiment indicators have turned sharply down. So we watch that very closely, and while I think people still have jobs, there will still be positivity in the marketplace.
Pete, you spend a lot of time looking at credit. Anything in there at the moment that suggests that the resilience might unwind?
Yeah, I know we promised not to have an agree-a-thon, but I generally agree with what both the panellists have just said. I think that we talk a lot about the pig in the python. So the impact of higher interest rates has been delayed. It takes a long time to pass through the python. If you look at commercial property in the US during the global financial crisis, it took 3 years really to see prices bottom out. And the reason for that, I think, is twofold. One is we've had a quite big softening in financial conditions if you just look at stock markets and credit markets generally. High credit spreads are very close to the lows that we had in the post-COVID environment, and that's with notwithstanding your comment before about the lower levels of defaults. It's actually much higher than what we were expecting back in 2021 when credit spreads were this low. So we've got really easy financial conditions right now, and so I think people are being lulled into a false sense of security. The other thing we talk about is hope not being a strategy, but right now hope is a strategy. So we've actually had no capitulation So we haven't had transactional evidence. If you think about parts of the commercial real estate market, there's evidence that that's starting to happen in the US, but certainly here, parts of the venture capital market, we haven't had transactional evidence of the impact of higher rates. And that's why our view is, a bit closer to that sort of harder landing than a soft landing view.
So we might switch this around, but we definitely want to focus on opportunities. What are some of the areas that are interesting and attractive to Morgan Stanley?
Yep.
More broadly, parts of the fixed income market that you're gravitating towards at the moment.
So we published a primer on private credit for our clients on the 30th of April, where we quite like the private credit space. We think that being selective about the exposures that you take within private credit, and I'll get to managers in a sec, that structurally there are some tailwinds behind the private credit market. As an example, US banks' participation in the loan market has fallen by 2/3 in the last 10 years, opening up a wide spectrum for private credit players to step in and take some good risk. Yep. And so we quite like that space at the moment. So we're seeing some good returns there. And touching back on manager selection, it's very important, and we do heavy due diligence on the managers that we use in private credit to understand where their exposures are, what they have exposure to, how competent they are in assessing the actual credits themselves. And that's key in ending up with who gets on our approved product list and the managers that we recommend.
And so is that getting visibility through to having some more visibility on what they actually own underlying it? Is that important in that process?
So private credit's a very broad church. There are a lot of different asset types that can fall into private credit. It's a bit like alternative investments. It could mean a lot of different things to a lot of different people. So we particularly like private credit in direct lending to corporates, so mid-tier corporates in the US and in Australia, and the products that are doing that mid-tier lending at a floating rate. We're finding good opportunities there. And also because of we've got global reach, we're finding some good opportunities in America in that private direct lending market.
And can you give me a ballpark for the types of return that you are able to achieve from an income perspective?
Yeah, so some of the returns that we're seeing are high single digits, and we intentionally, in some ways, don't chase higher returns than that because you get what you pay for in terms of risk.
Can I just add, I think that's very important, Simon's point about global diversification in private credit. So I think globally, private credit funds have been around for decades, and they went through the GFC, which was obviously in the US the biggest recession since the Depression. Here in Australia, private credit didn't exist before the GFC. Like, none of the funds were around, and we haven't had a proper default cycle here in Australia since '91. And most of the private credit funds in Australia are almost exclusively dependent on commercial property and resi developers or existing residential borrowers. So they're very real estate focused, whereas I think accessing global opportunities through the likes of Morgan Stanley makes tremendous diversification sense.
And the private credit market in Australia sits at about $280 billion at the moment, and that's grown 40% in the last 2 years. So the inflows into the sector are huge.
Pete and Chris, I'm going to give you both a quick opportunity just to introduce the part of the market where you operate and invest. But when you do that, what I was hoping you could do is just talk about some of the opportunities that do look attractive to you in your parts of the market. So Chris, why don't you kick us off, and then we'll get to you, Pete.
Yeah, so we trade high grade sovereign and bank and insurer and corporate bonds. So we trade about 700 million a day. We've bought and sold about 52 billion in the last 4 months. I have 50 guys globally, 11 traders, 18 analysts. We use 80 statistical bond pricing models to try and find mispricings, but focusing on super high grade credit, basically with no default risk, no liquidity risk. We tend to hold our positions for short periods of time, and then we introduce that into portfolios via sort of cash enhanced style funds, active credit funds, long short funds, unlevered funds, levered funds. Most of our strategies are floating rate. We do offer one long duration or fixed rate strategy, but our most popular solutions right now are probably strategies like our floating rate high yield fund, which is at levered high grade bank bonds. That's currently yielding 8.1%. It's A+ rated. It's floating rate. It has daily liquidity. Last 12 months, it's returned 11.8% net of fees. And then we have a long short credit fund, which is a global version of that strategy. That's done about 12.2% net of fees last 12 months, currently yielding about 7.3%. And then our fixed rate product, our active composite bond fund, is also an ETF, FIXD. Last 12 months, it's beaten the benchmark by about 4.4% net of fees, and that provides 5-year fixed rate duration exposure. But basically, where we trade, we're not looking for yield, we're not looking to take default risk or liquidity risk like other managers. We're really just focusing on alpha and total returns.
And to my question, where are you finding the opportunities at the moment?
Right now, we like high-grade financials up the top of the capital stack. So we're not so positive on hybrids. We think hybrids are very expensive. We don't mind Tier 2 bonds issued by big global banks. We don't mind senior ranking bonds issued by big global banks. But as the other panellists have said, I mean, corporate credit spreads look very tight. We don't really like corporate right now. High yield spreads look very tight. So the opportunities, I think, are actually, frankly, few and far between, and really focused on high-grade financials, liquid stuff. Everything else looks a little bit rich to us.
Pete, same question to you. Just explain to people where you find your opportunities and maybe talk through some of the things that look attractive to you.
Yeah, so we do the opposite of Chris. In short, so I'm in the business of lending people money and getting paid back. So we take credit and illiquidity risk in what we do. So Challenger Investment Management fixed income manages $17 billion, about 4 of which you could generically call private credit or less liquid credit. I think liquidity is a better sort of characterisation between public and private, because fundamentally, regardless of whether it's in public markets or private markets, you're sort of lending people money and hoping to get paid back. So that's principally our business. None of what we offer is daily liquid, and that's a really important distinction, because we are actively going into the market and seeking out illiquidity and seeking to get paid for that illiquidity. And so we offer strategies ranging from our credit income fund up to, which is yielding just over 7% cash plus 3 return target, up to, we've got cash plus 5 and cash plus 8 strategies, so investing across the capital structure. So we've actually been in private markets since 2005, so we did do it before the GFC, but as Chris alluded to, it was a very, very small market, and you were lending subordinate to the banks.
So you had a big player in there with you, is that right?
We effectively, in the corporate direct lending market, as it was back then, the banks were providing leverage buyout debt in senior, and it was only in junior debt where non-banks or alternative lenders like ourselves could play, but it was a small niche part of the market, certainly nothing like it is today. But we had the experience of going through the GFC and having to work out problem credits when the cycle did turn. And
is there anything now that makes you think back to those times? You think going into the GFC, is there anything that looks remotely similar?
No. In short, I think like the GFC, and my experience with the GFC, I was trading US subprime credit during that time for a London-based credit opportunities fund. So my experience of the GFC was really at the epicenter. Notwithstanding Chris's comments about the quality of non-bank lending in mortgage portfolios and levels of arrears, I think he'll agree that they're not quite what they were in 2007 and 2008.
And we like Challenger. We buy Challenger bonds, so we support Pete.
Yeah. But yeah, no, thank you on behalf of Nick Hamilton, our CEO. But it was a completely different environment in terms of the quality of credit underwriting and the amount of liquidity that was in the system. Even talking to high-grade banks at the moment, which I agree. I think high-grade banks and semis. I mean, semis are one of the few things that's actually widened if you think about the spread to govies like in the past 18 months. So I think there's certainly in that high-grade part of the market, there are opportunities. When we look back at 2007, where banks were trading in AAA RMBS, it's not the same today. So that's a good thing.
Simon, private versus public, that liquidity versus the illiquidity that comes with private markets. How do you think about that, and how do you use the two different styles in portfolios? We're
quite well disposed at the moment towards private, and we do like to seek those illiquidity premiums, or we're happy investing into managers that do seek those illiquidity premiums. We think there are structural tailwinds as to why those illiquidity premiums exist. From a tradable point of view, the conversation with clients is how this fits into your portfolio, and always aligning expectations of how liquid the asset class actually is, because you can't go and seek an illiquidity premium and then obviously expect high levels of liquidity from that. The only way to create that would be artificially. And so we have very good conversations with clients about expectations, and then we diversify across fixed income. So we will buy some public market, we will buy some duration, and we will buy some private debt. I'm keen to touch on a point that I introduced at the introduction, which is how do you make the most of this opportunity? And it sounds from the conversation we might be in a higher rate environment for some time to go, but for people wanting to, make the most of the high coupons, the high yields in the market, what are some ways that they can kind of lock it in or get the best of it for a longer period of time? I'll start with you, Simon. In terms of running coupons, I think the strategies that we've touched on are the right ways to do it. between the two other fund managers here and what we think. Getting access to good quality floating rate returns, taking an acceptable amount of risk for an acceptable amount of liquidity is a good way to access what is happening at the moment. The duration play is beginning to come back, and in a divergence from the Coolabah view, we think that there's going to be, Morgan Stanley view is we're going to get 3 rate cuts in the US this calendar year, starting from September, and we're going to get 3 rate cuts in the ECB, in the European region, starting probably in June, July, but 3 from both. So that's starting to look like a more favourable long duration environment if we are getting those rate cuts. On the other hand, if those rate cuts don't come through for whatever reason, if inflation is persistent, if services inflation is impossible to or very difficult to squash, and we don't get any rate cuts, we could see US 10-year rates going back through 5% again. So the short answer is we're already seeking those floating rate premiums, and we think that's a great way to access it.
Yep. Chris, same question for you.
In my personal portfolio, I'm about 25% long duration, 75% long floating. So,
And how much in equities?
0. I've got enough equity in my business. So I generally agree with Simon. I think duration, like when US 10-year government bond yields, which are like the global price of money, the tail that wags the kind of global asset pricing dog, when they were at 1% in 2021, duration was really unattractive. So investing in fixed rate bonds rather than floating rate bonds was unappealing. But today with US 10 years around 4.5%, it makes sense, I think, if you're a multi-asset class investor, if you need to diversify, and if you can take the volatility that comes with duration, I think having a bit of duration is attractive. I also agree that floating rate yields are very attractive. With the RBA cash rate at 4.35%, heaven forbid they might have to lift it a little bit further. I think that is a risk. They obviously thought about hiking at the last meeting, but on major bank tier 2 bonds, you can get circa 6%. CBA shares are only paying 5.7% fully franked, and Aussie stocks and CBA shares are leveraged 10 to 15 times. So you can take unlevered CBA bonds, get 6%, CBA shares 5.7%. So I think up and down the corporate capital structure, equities look quite rich to us. As I said, I think hybrids look very expensive. Tier 2 and senior look more attractive. And then if you can leverage Tier 2 and senior with cheap leverage, you can kind of get 8 to 9% yields that we think are pretty enticing. The one thing I would say, again, and perhaps a little bit of a departure from other views, is we actually think liquidity is right now very, very important. Liquidity gives you a lot of optionality because we think that there will be harder landings and future dislocations, and we think inflation is going to be persistent, and a lot of companies are eventually going to be forced to capitulate, as Pete was sort of intimating to. And then you've got this dichotomy in asset pricing right now where there's no margin for error price for equities and a lot of other asset classes like VCPE, commercial real estate. And what Pete was talking about is the commercial real estate guys are hoping bond yields come down. They're hoping interest rates come down. This is his hope point. But with US 10 years around 4.5%, and if MS isn't right and we go to 5%, that's going to crush a lot of those commercial real estate investors who are pricing their assets today on cap rates of around like A-grade office at 4.5%. So we think there's huge downside risk for a lot of assets, and you want to be liquid and have the optionality and the dry powder to be able to deploy that capital and capitalise on future dislocations. So we like liquidity right now.
Pete, question for you. How do you make the most of the opportunity at the moment?
Yeah, so it's a bit of a balance actually. So I'm going to agree with both panelists a little bit. So private credit, I think with public markets so expensive right now, that illiquidity premium has expanded. So we talk to people about trying to earn around 2% per annum above what your public index of the same risk.
That's the premium for going.
That's the premium for taking on illiquidity risk. But the good thing about doing private lending versus say venture capital is you're not reliant on some exit, right? Your risk is around the refinancing. Now you want to make sure that you're getting refinancing, and that comes back to the point around quality underwriting, quality manager, and I think that's a really critical point because dispersion of returns in private credit is going to be significant. So you want to pick the right horse or pick multiple horses, frankly, to mitigate some of those risks. But the thing with private credit is that you can pivot because we talk in private credit about the KISS principle, which is keep it short, stupid. So keep your lending short. So you're constantly
so you can recycling
and repositioning. And so the ability to go into public markets in the event of that volatility.
So you will do that. You will go into
absolutely. We talk about the 90-10 rule. So we want to be, we think 90% of the time, private markets offer that illiquidity premium. Markets are generally stable, but there are those periods of volatility, and frankly, that's when the best returns are available, and those returns are available in public markets, not private markets. Private markets stop, so transactional activity stops.
Yeah.
Talking about this hope thing, hope is not a strategy, people just stop, so they don't transact. Whereas public markets continue to turn over, and you can earn those double-digit IRRs in public markets during periods of volatility. So March of 2020, obviously April of 2020, we had the period in late 2022 where the UK pension funds and insurance companies had all their issues and the unwind there, and then obviously SVB a little over 12 months ago. So these periods of volatility are really critical. So the ability to move between and maximise your illiquidity premium when markets are stable, but also pivot into public markets when they're not, is critical. Now, within our strategy, we're giving up some of that optionality. Like, it's important to acknowledge that. We can't
just
pivot.
all of a sudden switch into public.
Exactly.
So I was going to say, like, what's
But
typical
we're-
duration? What would be average duration?
So of a mature private lending portfolio like ours, it'd be a credit duration of 1 to 2 years.
There's a saying, if it looks too good to be true, then it probably is. In the current environment, what yield do you think starts to look too good to be true? Pete, I'll start with you.
I sort of don't necessarily think about it in terms of a yield, but I totally agree with the sentiment. There's no free lunches out there. So it's more in line with an individual's sort of risk appetite. I think there's risk returns that are available. I tend to be more on the conservative end. So when things start getting into the sort of mid-teen type IRRs, I start to get a bit nervous.
Yep.
But that's sort of generally my predisposition anyway. So I'm going to tactfully avoid that question. I think if people underwrite risk appropriately and can assess, return for risk, there's parts of the market that, there's no hard and fast rule, I guess, is what I'm saying around sort of the level of yield where you start to get worried.
Chris, same question for you.
Yeah, I'd probably tackle it this way, that there are spread levels where we're comfortable and there are spread levels where we're uncomfortable. And as I mentioned, like high yield, which is an important benchmark for a lot of illiquid lending, single B spreads in the US are trading at about 280, 290 over US Treasuries. Normally, high yield bonds pay you about 550 over US Treasuries. And we're not getting that. And in a default cycle, which is what we're in right now, they normally pay you 750 to 1,000 over US Treasuries. So I think anything that prices off the high yield market and those really tight high yield spreads is problematic right now, and there are big red flags. Now, we could be wrong, and the way we'd be wrong insofar as the way those spreads would be rationalised is if we get some immaculate disinflation. If inflation zooms back to 2%, then the hopium prevails and it wins, and a lot of marginal borrowers will get bailed out. The one problem, though, with that argument is if inflation zooms back to 2%, the Fed has an unemployment rate sort of around 4%, so it has full employment, it has trend plus growth, and so that would imply that the Fed won't need to cut much, and you've actually got interest rates at around the right level. The Fed's only delivered one soft landing since World War II, and that was in 1995, and they only cut by 75 basis points. So the risk is whether you get a sharp reduction in inflation or persistent inflation, rates remain high for long, and the perimeter of the economy gets crushed. I think the core of the economy is fine right now. In most economies, it's really the marginal subprime borrowers that are going to get trashed.
Simon, my two guests have done a good job of avoiding giving me a number. As an advisor, is there a when you see something in double digits or something like that, does it make you nervous?
Yeah, what I'll do, I think, is explain to your audience how we think about these things internally, and it touches a bit on what Chris was saying. The risk-free rate in Australia is 4.35 or thereabouts. The Aussie 10s and the cash rate is about the same. If someone's offering you a return of, say, 14%, and we do get these inbound calls from clients, I've seen a deal, I'm going to get 14% interest, is that a good idea? I always bring the conversation back to that risk-free rate. So 14% is paying you 10% or 1,000 points over the risk-free rate. That is distressed high yield. Technically what that is in the market is distressed high yield. So 14% is also above the long-term equity return for markets. So investors have got to understand the type of risk that they're taking, and you can judge risk by a headline rate in many circumstances. So I would just express people to say, be careful, understand what you're doing, understand that a headline rate that looks something like that comes with its absolute share of risk. The other way you can think about it is what type of borrower has to pay a 14% interest rate in this market. So if you reverse that,
and if you're getting 14, they're probably paying 18.
Yeah, that's right. So it's hard to say how much is too much, and we try to tell people to think about it in those terms.
Well, that's where we're going to wrap it up today. Thank you very much, Pete, Christopher and Simon, for joining us on our Income Series panel. For all you viewers out there, I hope you took away a few insights around the opportunity in fixed income markets. Remember, check out the Income Series on Livewire. We'll be adding fresh content over the next couple of weeks.